Greg, we got Lennon on the line. What do you want to ask him?
What do you look for in your partners when you're forming a team, say in a different market than you might be today?
Good question. For me, it's more about the who. My partner and I right now, we kind of have very different personalities, but very similar skill sets. We're both engineers. Typically, people will say, well, you need to find a partner that kind of has different skill sets so they can compensate what you don't have, which makes all the sense in the world. That's fine. To me, a small challenge by having a close personal relationship where we trust each other and understand each other and like to spend time with each other. And we can figure out how to hire someone to do whatever it is that we're not good at. Right.
Mm-hmm.
And then if we're both good at something, then we can double down on that and get some exponential results versus just me doing that on him.
I'm Brian Briscoe, host of the Diary of an Apartment Investor podcast. And this podcast is different than everything else out there. I bring together a new and an experienced investor on each episode, and I let the aspiring investor ask the questions that they need answered. So if you're an aspiring investor yourself, you probably will have the exact same questions. Now, before we get to this episode, make sure you hit the subscribe button below and that little bell to make sure you get notified every time we post a new episode. And now, enjoy the show.
Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe. Very excited for today's show. We got two great people on the line with us. We got our experienced investor, Lennon Lee, and our aspiring investor today, Greg Tigan. So, gentlemen, welcome to the show today.
Thanks, Brian.
Thanks, Brian.
All right. And as we always do, the experienced investor is always up first. So, Lennon, let's talk about you for a second. Tell us a little bit about yourself. Give us an idea of your background.
Yeah, well, thanks again for having me. So glad to be here. It's always fun to share some comments and knowledge and just talk real estate in general. Originally from Venezuela, that's South America. A lot of people, when I say that, they hear Minnesota. It's not Minnesota. I moved here in 2010 with my family, and initially to pursue a master's. I'm an engineer by trade. I did my master's in engineering management. After that, I worked for a couple of years for a labels printing company. I was doing logistics and supply chain management. So a little bit of a corporate job there for a couple of years. Hated it. My boss hated me. I was working out.
Yep.
And at the same time, I was managing my family's real estate portfolio. Very small portfolio of, a few properties here in South Florida, Miami specifically. That's kind of how I got my feet wet into real estate and, dealing with tenants and managing a small portfolio. Ultimately, that was in 2009 when we bought it. I held all those properties until 2015 or so when I decided that we needed to take that equity and put it to work somewhere else within real estate, but somewhere else that allowed us, for us specifically, was very important for us to be very, very passive. Plus, we needed a little bit of a healthier cash flow than what we were getting at that point. So, and then growth, of course, if we could get a little bit of growth, then that would be nice. I found out about apartments, multifamily, and specifically about a vehicle called syndications that allowed us to participate in a passive way. And then obviously multifamily, it's just in general, whether passive or active, it's just a good asset class in general to generate cash flow and long-term wealth creation. So that made a lot of sense. Early 2016, we started our first investment as an LP. And I moved into the active side immediately. Got a mentor, started raising capital for a few deals, then found a couple of partners to actually join me on the pursuit of an actual 138 unit deals in Jacksonville. And we did the active operation side of the business on that deal. And then now at this point, that was a couple of years ago. And at this point, I have a company with one of those partners where we focus more on the equity raising. And we partner up with different operators across the country to bring deals to our investor base and to, of course, to ourselves and our families. Beyond anything else, we're limited partners and passive investors first, even though we're on the active side of things at this point. We kind of have that perspective and that mindset. And that's the way we look for our opportunities and business, et cetera.
I kind of subscribe to that too. I like to look at deals as an LP first. If it's a good opportunity for me, it's probably a good opportunity for a lot of other people. I think a lot of people who raise capital, that's kind of the mindset they have is, I like to be an LP and I just invite my friends along with me. It's kind of how a lot of people take that. And besides, you make more money when you have your own money in the deal. A lot of stuff there. I talk about the partnership and you talk about coaching programs. A lot of people who come on the podcast ask about partnering up. How did you and your partner come together
My current partner at Pasivo, which is our company,
Mhm.
and it's actually he was my first investor for the first deal that I was raising
Really?
capital. Yeah. So met him at a networking event, a CCIM luncheon thing that here in Miami. I was raising capital for a deal, and I was trying to network and try to hit all the real estate events everywhere, trying to hustle. I met him at this place. He kind of really subscribed to what I was talking about.
Mhm.
I did like a little presentation about who I was and what I
Yeah.
was trying to achieve. Yeah, he invested as an LP on my first deal.
Mhm.
Then he immediately, for I think after 2 deals, he was very interested in bringing some investors as well and getting on the active side of things and all that. So that's how it
Nice.
started. Then we did our own deal, and then we kind of formalized it under this company.
Nice. I like that. I like that. One of the guys that first came in as a passive investor on one of the deals I've done, we've now started partnering on deals ourselves. So I asked the question, like I said, it's a lot of times what the aspiring investors ask anyway. So when you talk about partnership, how do you link with partners? I had a couple partners I linked up with in a coaching program, but the way you talk about it, the fun part is you never know when you go to these events who you're going to meet and how it's going to change, So I was at a big event 2 weeks ago and somebody asked me how the event was. And I said, ask me a year from now. That's when I'll be able to tell you if it was a good event. But so cool. So yeah, you met him. He was a passive investor first. He moved from passive to active. Now you guys are partnering up and raising capital full time now.
Yes.
Cool. I love that. So what were some of the challenges you had getting into this business as moving from your engineering background into this business?
So a few things. Well, one of them, I guess it wasn't like a major challenge. It was like the language barrier. I have pretty good English, and I grew up coming to the United States every year, and I lived here for a couple of years when I was little. So my English was decent, but I never really had to use it in a business setting, like in a more formal, technical type of thing. So I had to read and learn a lot and listen to a lot of podcasts and understand what the jargon was and how people use different terms. Like that was a little bit of a challenge. Obviously, English not being my first language, but again, nothing too major. I think the biggest thing was overcoming the imposter syndrome. I think we all been there. To me, especially being like a younger guy, and like if you see my partner, like he's on the older side, so we kind of compensate pretty well. And especially if you're raising capital and you're the face of the business, right, in front of investors and doing that, where you need to build trust. A lot of people, a lot of our investors are older that maybe trying to retire at this point or something, so obviously they look at a younger guy maybe with not much of experience. It felt like I wasn't supposed to be there, so I think the way that what really helped was having partnerships with people that did have experience. And at the end of the day, it's just, it's marketing or marketing play, if you want to call it that. But ultimately, you're selling the team instead of selling yourself until you can sell yourself.
Yeah.
Right. I think that was the biggest one, but there's always a bunch of challenges.
I think you got to do what I do and put a little bit of gray in your beard, instead of black, dye it gray, and that way you look a little older, right? Yeah. I don't do that. The gray is real, but yep. And Greg's showing off his beautiful head of hair. There's not a lot there, but that's why we wear hats, right? But
we're all with hats, actually. Yeah. So I'm always in my hat. That's the thing, right? Like it was a challenge, and I guess sometimes it still is, maybe with specific investors, specific people. But it's not a problem anymore, because at this point, I do have the experience. I know what I'm talking about. I'm investing my own money in these deals. So the conversation, it's more like you said before, like it's more like an invitation rather than me selling you something. Although I think we're all selling something all the time, right? But ultimately, now it's gotten to the point where it feels good to have gone through that, because you understand exactly who you are, how you want to present yourself, and you understand the value of being genuine and authentic and just being yourself. Because numbers and spreadsheets and due diligence and all that technical stuff, yes, need to do it. It's cool. Of course, it's part of the process, but ultimately people, especially investors, like passive investors, they're just trying to give their money to someone that they trust. And they're never going to trust me or anyone if I'm trying to be someone else. If I'm trying to be on a suit and tie, if that's not me, then it's going to show, for example, right? So that all those minor things kind of affect how you feel and how you act, and ultimately the success that you're going to have. And I think this goes for every business, but
Yeah.
what we do.
And something that just connected in my head. I mean, you talk about the imposter syndrome, and it sounds like your method of getting around the imposter syndrome is to not be an imposter, to be genuine, to be yourself. And I just made that connection. I think it's brilliant. Be yourself, and you're not being an imposter. So,
and just showing people that, and this is one of the biggest ones, is it's okay to not know what you're doing, to an extent, obviously, right? I mean, but what I mean, and show that, and just make people understand that, listen, this is why I do what I do. This is why I'm putting this in front of you. This is what this makes sense. If you ask me this question, I can't answer because I don't know. I have no idea what that means. But let's figure it out. Ultimately, we're all in this together. I think long term, we all have the same goal, which is time freedom, financial freedom, however you want to call it, right? So, it's
and you mentioned this earlier on your first deal. You said you were relying on other people's expertise, and that's what most people do. That's the other way to get around, I guess, the imposter syndrome, or feelings of a little inadequacy, is you rely on someone else's experience. You point to, hey, I'm partnering with these guys because they have a lot of experience, and that's one way that you can. I'm going to use the word deflect because I can't think of a better word right now, but when people come to you and ask you about your experience, you can always, well, I don't have a ton right now, but these guys do. They're really amazing guys, or whatever, and borrow their experience and credibility. Let's shift gears slightly, and let's talk about one of the deals that you've done. So pick your first or your favorite or most recent, and tell us a little bit about it.
I always bring this one up because it's the one that we've been. Obviously we're involved in all of our deals, but this is the one, the Jacksonville deal. It's the one that we did pretty well, and it's one that we kind of saw it through from the not even having a deal, not even having a market to invest to target, all the way down to securing this, raising the equity, the debt, and everything, and the operations, and selling the deal and everything. So it's a 138 unit property that we bought in Jacksonville in 2019. At the beginning of 2019, and sold it towards the end of 2021. So 2.5 years, 2 years and 8 months or so. Yep. And you want me to just talk to the whole?
Tell us. I mean, what was it? Value add, C class, B class?
1974 construction, C class deal on for sure B minus, if you will, B area. The classic value add story that we all kind of been pursuing of this past few years. And classic value add play. We found the deal on the market, and before we found the deal, we took the time to go to the market and establish relationship with all the brokers, like all the big names, etc., to really get to know them, and have them get to know who we are as a group, and on all that. When the deal came to the table, we luckily the broker that had the listing was one of the brokers that that we had a better relationship with. So he really put in a good word with the sellers. We got into best and final and all that. He put in a word for us, and they awarded us the deal. We had to raise. We bought it for 12.07, and raised $4.2 million in equity. We raised $1 million. This was in the form of debt for the renovations.
Okay.
Held it for 2.5 years. We had a property manager, third party. That after a year we had to change it. There was a big challenge to do that. It's very intense, but we were able to identify a new property management group that they killed it from then on. And I think we invested like $8,000 per unit and renovated around 70, half of the property pretty much.
Yeah.
New pool area, furniture, like dog area, dog park, this and that, like, very minor stuff.
Yeah.
And big rebranding. And ultimately we repositioned the property and were able to achieve 22% returns for our investors per year, which is pretty good.
I'll take that all day, every day, so yeah, 22%, sure. Where do I sign? So
Yes.
Send me the wiring instructions and I'm in, but yeah,
I
so
know.
well, hey, cool. Hey, thanks for sharing that. I appreciate that. I mean, Jacksonville has been a great market. And, when you said you bought in Jacksonville 2019, I kind of figured you'd have a really good, end game on that one. But yeah, classic value add. You get in, you make the place look better and you sell it. That's kind of what we do. So let's talk about your why, the reason you do this. What is your why?
Two things, or I guess three. The big one is it's for my family. Just, again, mom and dad, they're living in Panama. My sister and the whole family, they're living in Panama. What we have here, it's pretty much all we have as a family. So ultimately, it was really about identifying a vehicle that was going to allow us to, like I always tell the story in every podcast that I go. It's just my mom kind of gave me the green light to, okay, you manage the whole thing, but please don't lose my money. Do whatever you want. We do whatever you want to do. Just don't lose my money. So with that in mind, I think that's specifically the reason why I do what I do, which is multifamily. And there's a specific reason why, well, just commercial real estate in general, but family specifically provides that, especially the type of deals that we do.
Yep.
The way we structure and all that, we can talk about that. But the idea is just to structure it in a way that is going to be very difficult to lose money. Right? So capital preservation first, and then of course we want cash flow, and then of course we want growth. So that the main reason is family, but then also I think specifically the syndications aspect of it is just opening the door to a lot of Latino and immigrant investors that come to this country, and all we know is just buy a condo in the best area in town and rent it out. That's what we do. Maybe some house flipping here and there that some people will do, but like that's all we know about real estate investing. So we never, most of us don't know that this is an opportunity, that this is an option. So I think regardless of if we continue to grow and build like a big LP fund or whatever, wherever we're going, ultimately, I think we're always going to have that opportunity for small retail investors to invest $50,000 per deal. It's just part of why we started this. Yeah.
Nice. Love it. And last question for you. What's next?
What's next? Well, yeah, just continue to grow our investor base and provide as much value to them and of course to ourselves. The idea for us, our thing is just trying to become better investors every day. And that of course means better passive real estate investors. But better investors in general, right? And we're trying to achieve that through something called that we just launched, the betterinvestorclub.com, which is basically an online platform for passive real estate investors to connect and share knowledge and obviously learn and grow and just do deals together, man. And try to help each other. Yeah.
All right, and we'll make sure we have a link to that in the show notes. So betterinvestorclub.com. But hey, cool. Well, hey, thanks for sharing that. We are going to shift gears and bring Greg on. So Greg, welcome.
Thanks, Brian, and appreciate the opportunity to be here, Lennon. Thanks for sharing. That's a really great story. Thank you for sharing that.
Well, hey, Greg, do us a favor and tell us a little bit about yourself.
Well, let's see. I'm from the Mid-Atlantic states of the U.S. here. Been born and raised in Maryland, Baltimore. I now live in Philadelphia, in the suburbs of Philadelphia, and I live here with my significant other of 12 years. And we're basically empty nesters. We've got a few kids, and they have all sort of moved on. In fact, my son is in the Army, and he was just texting me before the show here to say, "Hey, Dad, I'm on my way, and guess what? We're moving to Alaska." So we have that to look forward to in the next couple of months. So he'll be over in Alaska for about 3 years. So we have, I guess, some traveling to Alaska in our future too. So that
Good
can't be
old
a bad
Fort
thing.
Wayne Wainwright. Yeah, we talked about this a couple days ago, but yeah, I spent a month there when I was still active duty. It's a beautiful place. Go there in June, not in December, is my only advice.
I said to him, "You must have drawn the short straw if they're sending you over there in January." And he laughed, but they've got it all figured out. That's what they
Yeah.
do.
Yeah, it's a beautiful place and hope you get some mileage out of it. But so you're in Philly. What did you do professionally?
So my background up until I got into real estate was corporate IT, project management, applications development support, that sort of thing, for close to 30 years for a variety of different industries, food and beverage, pharmaceuticals. Worked for some pretty big companies, but things happen, things change, markets change, needs change, and found myself at the age of 50, getting laid off from one opportunity. I was offered a package, but didn't want to relocate at the time. And so found another job quite rapidly and then thought, oh, gee whiz, this is great. I found the next place that I'll retire from. I thought the first one was the great place to be where I retire from. And 7 years later, they went through some slumps and they laid a bunch of us off. So I took that package, never looked back, to be quite honest. I never looked back from that. At that time, I had already started investing in real estate, decided that's what I was going to do full time and just hit the ground running. Scaled down the lifestyle, did what I had to do, sold the big house for the small house, and just started investing in myself and in the business. And I've been doing investing for full time for about 6 years now.
Yeah, interesting. You say sell a big house for the small house because we got 5 kids, but 2 of them are out of the house already, and I'm already starting to think about selling that big house for a smaller house. But when did you start investing in real estate, and kind of what prompted that?
So it's a funny story. I hope we have time, and I don't talk too much. Brian, cut me off if I am. But somewhere in that period of time I was describing, I was going through a rough patch with my wife. We're since divorced, so there's all that dynamic happening. We weren't quite divorced, so there's outflows of cash going to all the places that they go when you're in that situation. And I called a friend of mine. We were coaching baseball together. My son played baseball since he could walk. I called my friend and I said, "Hey, I heard you're doing this thing with houses, rehabbing houses or something." And I was about to ask him for a job. I was asking for, a few bucks on the weekend, can I come work for you? And the first thing he said was, "Hey, Greg, you got any money?" And from there, it was, the whole runway towards investing. So that's how I got into it, sort of by accident. That was my first partnership with that individual, and
Nice.
it didn't last, but it was a very good learning experience, and I still own that property to this day. So he must have known something that I didn't then, obviously,
Yeah.
right?
Nice. All
Yep.
right. So one question that I like to ask everybody, and you get it too. So what's your why? Why are you in real estate, and what are you trying to get out of it?
So I'm trying to recover and get back to financial stability. And I saw real estate as a way to do that, restore my net worth, grow my net worth. But ultimately, at the end of the day, I'm a cash flow investor. So I really am doing this for, cash flow primarily. Let the appreciation take care of itself, and the net worth will grow and take care of itself. No different than many others. Family's important to me. Lifestyle is important to me. But when asked this question, I always try to be a little bit creative in my answer, and I'll describe financial freedom as durable financial freedom, because you could flip a house and have a bunch of money in your pocket for a few months until you waste it on something. But I want to be able to survive pandemics, market cycles, whatever it might be, and always be secure and never have to worry about it or worry about it so much. And so I call it durable financial freedom. And then that yields everything else, the time freedom and abilities to make choices and things in life that we didn't have the other opportunities to do.
Durable, something that's not going to change based on which direction the wind's blowing. So I like that.
Yep.
All right. So here comes my favorite part of the show. It's where I get to sit back and listen to a lot of stuff going on. So, Greg, we got Lennon on the line. What do you want to ask him?
Well, gee whiz, with so much experience, you saw my list of questions, Brian, so I've done my best to try to trim it down a bit. But I think the things that strike me the most are about the way you develop your partnerships, Lennon. And so I'm looking for some advice on trying to duplicate that. I have some formative things happening in different parts of the country. We're looking at things locally here in Philadelphia. I've got some budding partnerships in Texas, different markets. I'm still trying to just figure out, is it more important the who or the what do they bring? Like, are the skills, like we talked earlier about underwriting or due diligence things, the operational stuff. What do you look for in your partners when you're forming a team, say in a different market than you might be today?
Good question. For me, it's more about the who. It always is more about the who. Actually, to be honest, we might be wrong, right? Time will tell. But My partner and I right now, we kind of have very different personalities, but very similar skill sets. We're both engineers. Of course, we have some challenges trying to do things that he's not good at, that I'm not good at. And like we overlap in a lot of things as well, which typically people will say, well, you need to find a partner that kind of has different skill sets so they can compensate what you don't have, which makes all the sense in the world. That's fine. To me, a small challenge by having a close personal relationship where we trust each other and understand each other and like to spend time with each other. And we can figure out how to hire someone to do whatever it is that we're not good at. Right. And then if we're both good at something, then we can double down on that and get some exponential results versus just me doing that on him. So I don't think there's any right or wrongs ultimately, but for me, it's very, very important to have a good relationship and really like the person that I'm doing business with and that I'm in a partnership with. It's like a marriage, it really is. So if you want to go for the long term, then yes, I think that's going to be more important. So. And I look for that not only with my immediate business partner, every other partnership that we establish with our operators and all that. There's a lot of good people and the companies or operators on paper. You can do background checks. You can do, run the numbers, check their track record. All makes sense. All good numbers, everything. So ultimately, it's a matter of, okay, they're all good, but do you want to do business with all of them? Probably not, right? So that's the way I see it.
Yeah, and I tend to agree. I mean, most people will say the ideal is that you have a complementary skill set. But if I had to pick one over the other, skill sets versus, just are they people you want to work with, people you get along with, go with, I'm going to agree 100% with Lennon. You go with people you want to work with, people you have a good relationship with, people who have the similar values and alignment. And that's kind of recipe for long term. And I really like what Lennon said, if you guys are agreeing on everything, you can figure out how to bring in other people to compensate for the skill sets you don't have.
Could I ask a quick follow-up to that question, Brian?
Yeah.
So in developing the partnership structure, it sounds like you only have one other primary partner, so maybe it's easier. But some of the deals we've looked at, we're looking at 4, 5, 6 different people all playing a primary role, but we're all pretty astute enough to know that we're going to have to contribute to different things. We're all going to have to capital raise and probably all assist in due diligence and these kinds of things. So how important is it to make sure you've got a good, solid, agreed deal structure? We're splitting it 50-50 if there's 2, 25, if it's 4, that kind of thing. Like, what are your experiences there?
Yeah.
The way we see it, and this has been, through the experience that I've had, working with different operating partners and syndicators and structuring our own deals as well. There's I guess, unwritten breakdown of how a partnership normally works, especially on the GP side, because and I'm talking now let's say an apartment deal, right? Where you're going to have LPs, then you have the GPs. Obviously the LPs are the LPs, you structure them typically 70-30 with the pref, and then a waterfall after that, maybe 80-20, maybe 90-10, whatever, right? But what you get on the active side, whether it's that 30 or 20%, if you see it as a whole pie now, normally you're going to see around 30% of that go for the equity, around 10-15 even, but let's say 10% on average for maybe a key principal or key principal on the deal. So whoever brings the risk capital, if there's someone that brings it, maybe you give them 3.5-ish, 4% of the GP there. And then whoever sources the deal, underwrote the deal and all that, maybe it's 5%. I've seen 5-10 even. And then the rest, it's asset manager, lead operator on the deal. So, and there's a lot of overlap within that, but that's kind of, good reference to have to, for one of these deals.
Yeah. And I think take that one step further. It's different when you're putting deals together with lots of people who are coming in on a deal specific basis than it would be if you're forming a team. If it's a deal by deal basis, what Lennon said is exactly right. There are unwritten percentages in the industry of of how most people do things. And it's just a matter of you bring more value to the table, you're going to get a larger percentage. But once you get more comfortable with working with people, or if you decide to form a more long-term partnership, then the negotiations come back out and it's like, all right, are we doing this 50-50? Are we doing this? How are we going to do this? That's a whole nother situation right there. But end of the day, you're going to get compensated for how much value you can bring to the table.
Thank you.
Yeah.
So let's talk about markets. I heard you're in Jacksonville to start. I'm sure you branched out. What advice do you have for finding the next market? And along with that question, do you look for primary markets? Are you comfortable in secondary markets? How do you feel about tertiary markets?
Well, all of the above. I think that in general, it's pretty straightforward. And I think, I don't know, every time I say this, I sound repetitive, like I'm repeating myself a lot in terms of population and jobs, and just making sure that jobs are actual good jobs. And I would say a fourth component, it's affordability, specifically talking about Jacksonville. I don't know right now, it's probably a little bit higher, but it's probably still very attractive in terms of the affordability ratio. It was 17% when we looked at it. And that's basically what it means is if you have a job, whatever income that you have per year, only 17% people are spending on their rent. So that gave us a lot of room for going in, improve the property, offer a better product, increase rents, and still be affordable for most people, right? And that actually it's one of the things that we like to see in the markets that we invest in typically. But yeah, it really is just job growth and just moving people that are moving to the area. They need a place to live and they need jobs to afford their rent. Of course, then you have the landlord friendly states, and you have more micro things that you need to look at, like some market wise, because market numbers are one thing, but the dynamics of that market inside of it changed a lot. And for example, what we did in Jacksonville, that gave us the advantage over different groups. We've done a couple deals, but on that deal that I talked about, part of the reason we got the deal awarded to us is because we were able to identify and look at something that most groups putting offers out of state without really understanding the dynamic of the Jacksonville market. They were not able to see it. It was just a creative rebranding, change the name that was similar to another area that was close to us. The area was better. So we kind of made a little bit of a marketing play there that allowed us to position the property in a better way. And the only way to see that is just to be there in the market and understand, what changes from one street to the other and that type of thing. So that's also part of how we look at markets. It's just really being there in person and try to get to know the people, the dynamics, everything. So, it's a lot, but it's worth it.
Yeah. I'll add my 2 cents in on that one. You ask about primary versus secondary versus tertiary. There's trade-offs every time you go in it. Primary markets are going to have a lot more competition. All right. There's a lot more apartments available, but they're going to be more competition in the primary market. So for a lot of the newer apartment investors, sometimes you can find stuff and be able to buy stuff easier in the tertiary markets, right? But there's trade-offs there as well, because tertiary markets are tertiary for a reason. I don't think it matters as much. I think what really matters is kind of where Lennon was going at the very end, is you got to be an expert in your market. And I would say if you're the person looking for deals, you need to find a market where you can focus on. Pick one or two, that are large enough to give you deal flow, and focus on those markets. So those dynamics that Lennon was talking about. If you're looking at several different metros, if you're looking at a deal in Dallas today, Nashville tomorrow, Orlando the next day, you're not going to get that detailed knowledge of a market to be able to do what Lennon was talking about. So I would say, just adding to what he said, he hit a lot of great points, is once you find a market that you like, focus on it to the point to where you know it better than anybody else.
Thank you. Lennon, you spoke a lot about you and your partner being sort of more playing the capital raising role, which is, we all know, very important. But what are you doing for acquisitions? Do you just bring on people who have deals? Did you build your own deal funnel? Do you outsource that system, or do you bring an acquisitions person onto your team? How do you find your deals is basically the question.
Thankfully for us, deal flow, it's not really a problem. And this is by design. Our business model is to partner up with different operators. These operators are out there sourcing deals directly and building broker relationships and trying to get off market and on market deals. Like, they are the ones that are actively sourcing the deals. And of course, they're going to underwrite them. And if it's something that they like, then they put it in front of us. So not only, and then we have that. And right now we have 4 operators that we have done already deals with, that we work with. And we're trying to expand that network. Again, we're trying to do the job that any good LP should be doing. Of course, it's going to be at a higher level because we're actively doing it and professionally analyzing these deals and building these relationships. But that's kind of the idea, right? So our deals come from different operators that we work with. So ultimately, not only we get more quantity, but by the time that we see them, it's a better quality deal flow because they're already curated by our operators. So then we do another layer of underwriting and analysis, but that kind of gives us that deal flow. So we're not talking to brokers right now. We do get sent deals, by email every week, every day even. We're not actively sourcing deals ourselves and talking to brokers at this point.
So you guys don't have a team that goes direct to seller. You're relying on the operators to bring.
No, because we're not. I mean, we don't want to be operators ourselves. So we let our operators source the deals. If they put it in front of us, and if it's something that makes sense, we'll work together on that deal. But
yeah, his deal flow comes from operators. He gets to know operators that do all that stuff that are really good at it. There's a guy that I really like in this industry. I had a phone call with him, several months ago, and he's an operator, and he says, "I'm really good at finding deals. I'm really good at operating deals. I don't like raising capital." Basically, Lennon looks for people like that who are good at that, and that's how he does his deal flow. They look at 100 of deals to find one, and he reviews the deals that they bring to him. So super great way of doing it. All right. So we are out of time now. So last question for each of you. Lennon, you get to go first. How can listeners learn more about you?
betterinvestorclub.com. Yeah, just go there, join the club, and you can get to chat with us, talk to us, and to not only us, but all the other members of the community. We just launched recently, so it's a growing community. We're just getting started, trying to get people to adopt the new platform and everything. A lot of value being shared. We explore different topics. Ultimately, we're all trying to become better investors, better humans, and years of life. That's what we're trying to achieve there. So yeah, that's the best way. If you want to out on Instagram, just go to Lennon LD on Instagram. I'm very active as well. But other than that, betterinvestorclub.com.
All right. Sounds good. We'll have that information in the show notes. And Greg, same question for you. How can listeners learn more about you?
At this point, Brian, the best way to reach me is through Facebook or LinkedIn. And I will mention that we have just engaged with a website developer for putting up a website under tfsrealtyllc.com. And hopefully in a couple of weeks, we'll have at least a landing page up there and a way to contact us as we're trying to do all the same things you guys are doing with promoting your businesses and getting exposure. Awesome. And that's great. Thank you. I appreciate it.
All right. Thank you. Well, thanks guys for coming on the show. I very much appreciate your time, and this was a lot of fun.
Thank you, Brian.
Hey, if you like that episode, make sure to subscribe. But more importantly, if you haven't joined our multifamily educational community yet, which we call the Tribe of Titans, you are missing out. Get 30 days free by clicking the link in the description to this episode, or go to thetribeoftitans.info, and we'll see you there.